All right, so today we're going to be talking about package investments. So today we're going to be talking about the different type of investment companies. So that's like mutual funds and that kind of stuff. And then the variable annuities, open and closed funds, differentiate between class A, B, C, and no load share classes, break even points, letter intent, pretty easy stuff. All right. So as far as the different investment companies, all you gotta know is this little chart right here. So the first thing you have here is your investment company, and it branches down into three different pieces. Okay, so the first one here is going to be the face amount certificate. This right here, you hardly ever see it. Not very common, not common anymore. It's like old stuff. Okay, so that's that. This side. There it is. All right, cool. And the next one here we have managed investment company and then unit investment trust. So with managed investment company, it's going to branch down to open-end mutual fund. So open-end mutual fund, that's going to be what we offer here at Primerica, okay? So we offer the mutual funds. And you can have either diversified or non-diversified, okay? So diversified, it's very simple. We're going to put it in different areas. That could be technology, pharmaceuticals, you name it. It's in different markets. Now, non-diversified, that could be like one particular sector. Let's say it's energy. So they invest all the money right there in energy, so it's not really diversified in the market. So the entire market for energy goes down, the entire portfolio, it's gonna go down. Okay, any questions so far? Are you guys good? Good. And then once again here, right, the point here says open end. So it's going to be doing infinite shares each month. Okay, so it's going to keep on having new shares in there. They're going to keep on doing research, finding out what new companies they're going to put in that particular fund. Okay, so it's going to keep on going and buying shares of new companies. Now, right here, you have close end. So close end, you're going to have a big pot and you're going to have to buy that entire pot of that fund. You're not going to be able to buy, you know what? I only want half of it. You're going to have to buy the entire pot to get that investment. Okay. And like right here, the way I think about it is kind of like a hedge fund. That's the way I think about it, hedge fund. Okay. And then here you also have diversified, non-diversified, same thing as right here that I explained earlier. Okay. And it's very important that you know these three different types of investment companies. They'll quiz you on like, what are some investment companies? You're gonna say right here like base amount certificate, managed investment company, unit investment trust, and they're gonna throw something out there and out of the blue. Okay, so you gotta make sure you know the difference between that. Okay, so here it is. So the first one here we have is called a face amount certificate. Okay, so overall, it's a contract between an investor and an issuer in which the issuer guarantees payment of a stated face amount to the investor at some date in the future. Okay, so this to me, when I first read it, I'm like, you know what? This kind of sounds like a CD, certificate of deposit. Okay, so at that point, they're gonna give you some interest rate, 2%. At the end, they're gonna give you some amount of money at the end. Okay, so that's the way that I first read it when I was reading the book. Okay. And once again, very few companies operate today with this. Okay. And now the next one here we have is a unit investment trust. So these are pretty much going to be fixed. It's going to be a fund that is a whole bunch of either bonds, stocks, and it has a particular goal for that client. There it is. It is an investment company organized under a trust indenture. Unit investment trusts do not have a board of directors. They have trustees, but not board of directors. So name an investment out there that has a board of directors.
Wait, repeat the question.
So name a fund out there that has a board of directors. Investment, anything like that. Think about like what's out there has a board of directors.
Like I know stocks, like Amazon has board of
There you
directors.
go. Stocks. Stocks have board of directors. These right here are not stocks. That's why they're not going to have board of directors. They're going to have a board of trustees. Hence the word unit investment trust. So that's why they're going to have a board of trusts. I mean, they're going to have trustees, not a board of directors. Okay. Does that make sense? Okay. Next one here is that UITs create portfolio of debt or equity securities designed to meet the company's objective. They then sell redeemable interest, also known as units of shares, okay, in the portfolio securities. Each share is an undivided interest in the entire underlying portfolio, and they can be either fixed or non-fixed. Okay, and then most of the time, this right here, they have low fees because whatever you have, it's pretty much a set thing. We have to really, you don't really have to oversee that fund. So it's gonna be like low cost. Okay, because a fixed UIT portfolio is static, there is no need for active management and little to no portfolio turnover. UITs do not generally access management fees because there is no need to hire an investment advisor to monitor and trade position within the portfolio. A non-fixed investment trust shares on the underlying mutual fund. So overall, these right here, they have low cost because you don't have to really oversee this fund with an investment advisor like a portfolio manager. Okay. Any questions so far on this? No? All right, moving on. Okay. All right, so right here we have managed investment companies, closed and open-ended. Okay, let's see what we have here. All right, so here it talks about the difference between open end and closed end. Is an open end, it's gonna be a whole bunch of initial public offerings. So like Microsoft, Amazon, they're just gonna keep on buying and releasing new stocks every month in that mutual fund. Now, closed end companies, initial offerings of shares is limited. What you buy is what you get. Okay. Now, right here with closed-end investment companies, they're going to raise capital for its portfolio by conducting a common stock offering. So they're going to trade that stuff in the market. Initial offering, the company registers a fixed number of shares with the SEC for themselves, enough prospectus, whatnot. And then once shares have been sold, the fund is closed to new investors. Here it is.
So it's not an IPO?
Not really, no. The fund elects to be a closed-end company because the sector in which it tends to invest has a limited amount of securities. That's why. Here it is. This is why it's called a closed-end fund. The fund elects to be a closed-end company because the sector in which it intends to invest has a limited amount of securities available. That's why it's closed. So supply and demand. Once it's gone, you can't buy any more of it. Now here, closed-end investment companies can issue bonds and preferred stock. Okay, that's the main difference between open-end mutual funds. You cannot do preferred stock, and technically, you cannot issue bonds as well. Okay, and then closed-end investment companies are also called publicly traded funds. And one thing here is that the way that you calculate the value of the fund is actually based on this right here. It's based off net asset value. Okay, and then You're gonna learn later on in the book, but whenever you have a closed-end shares, the only way that you can sell it is if you directly sell it in the secondary markets. That's the only way you can get money from this closed-end funds. You have to directly sell those funds on your own. Okay. Let's keep going. And here it is, open-end investment companies. So open-end investment companies. Give me a second here, I'm like moving this side. All right, cool. Here it is. So open-end investment companies, an open-end company only issues one class of security, which is common stock, no preferred shares or bonds. Okay. It does not specify the exact number of shares it intends to issue because it's literally infinite. It's going to keep on buying shares and shares each month / day. Okay. In other words, the mutual fund conducts a continuous primary offering of common stock. Okay, with this registration type, they can raise an unlimited amount of investment capital by continuously issuing new shares. Okay, so that's the main difference here between open-end and closed-end. Open-end, they're going to keep on buying shares each month, every day. Closed-end, whatever they buy in that fund, that's all they get. Okay. Now, on the other hand, for open-end mutual funds, when they want to sell their funds in open-end, they're going to directly sell it to the fund itself. That's the way they're going to get that money. Okay. Okay, so that's open-end. Let's keep going. And like, one other thing here is that this part here, I'm going to read it. Okay. This part here, make sure you guys read this last paragraph here. This here, you're gonna have to make sure you understand it. You're gonna have to realize how the net asset value of that fund, it's gonna get affected whenever you get dividends, you redeem cash, you sell, whatever it is. So just read the last paragraph right here. Well, I'll drink water. Okay, does that make sense? All right, and here it says mutual funds are priced at the end of each business day, with sellers receiving the next calculated net asset value and buyers paying the next calculated public offering price. Okay, all transaction requests must be entered by 4 p.m. And do you think this time here is 4 p.m. Pacific or Eastern?
Eastern. The market closes at 1 p.m. our time.
Yep, exactly, Eastern. Any requests to buy or sell that are entered after 4 o'clock p.m. will receive the next business day net asset value or public offering price. The seller who places an order after the close of 4 p.m. will receive Monday net asset value when liquidating their shares. Okay, so that's pretty easy. All right. All right, so this little chart here, be sure that you guys memorize it. It shows you the difference between open-end and closing in a simple way you guys can look at it. So right here tells the capitalization is unlimited. They're going to keep on buying new shares. Closed-end is going to be fixed, single offering of shares, and issues only common stock, no debt securities, but it's permitted to borrow. Okay, and for closed-end right here is common preferred stock, debt securities, etc. So make sure you guys memorize this little chart for open-end and closed-end, and it'll definitely help you guys to actually pass the exam. Okay. Now, right here, we're going to do a little quick little quiz. Let me zoom in a little bit. All right. So under the Investment Company Act of 1940, all the following are examples of managed investment companies. Okay, except what do you think it is?
A.
Which one? A?
A.
Okay. Two, one characteristic of an open-end investment company that distinguishes it from closed-end is that it may avoid taxation by distributing all of its net investment income to shareholders. Okay, it may either diversify, they can both do that. Okay, there are a wide variety of objectives available for investors to select from. That one is they can do the same.
Right.
I would say probably between
D.
A or D. What do you guys think?
I say D.
D as a dog? Okay. And then three, an investor can take advantage of intraday price changes due to normal market forces when investing in what do you guys think it is?
One and two.
I would say 1 and 4.
1 and 4. Me personally, I already know it's going to be this one here. So you guys think it's 1 and 4,
C.
2 and 3?
Hedge funds trade all the time. Intraday. That's how they make their money.
Okay, perfect. All right, let's check. So 1 was C. So it's the Windmill Income Unit Investment Trust. Unit investment trusts are investment companies, but not management companies. Okay. So remember, management companies, it breaks down between open end and closed end. Okay. And then 2, the key difference between, and then 2 was D. That's good. And then 3, it was A. Okay. So it's going to be 1 and 2. So closed end funds and exchange traded funds. There it is. So closed-end funds, ETFs trade in the marketplace based on supply and demand. Open-end funds are forward pricing and generally priced only once per day. Okay. Let's keep going. No, I realize I haven't taught the ladies today. They all left.
They don't want it, Oscar. They don't want it.
I know. All right. Now we have a sausage fest.
Oscar, you got no chill, bro.
Huh?
Oh,
I see how it is. I don't know. All right. So right here we have variable annuities. Forget I went to school for engineering. It was pure sausage there. No girls. All right. So variable annuities. Here it is. So right here it talks about annuities. So in general, the basic definition of annuity is going to be an insurance contract that's going to provide retirement income. And that income can be given to them each month, every weekend, etc., for a certain period of time. Okay. And it's going to have a guaranteed period. Okay. So with that in mind, there's different types of annuities. There's fixed, there's variable, okay, and there's another one called it's called the index. Okay. Okay. That might be for the life of the annuitant until the annuitant reaches a certain age or for a specific number of years. The actual amount to be paid out may or may not be guaranteed, but the stream of payments itself is. Because an annuity can provide an income for the rest of someone's life, the contract has a mortality guarantee. Okay. The mortality guarantee, it's going to be different for women versus men. And what do you guys think? Why do you guys think that's the reason?
Because we're both different.
We're different, right? And who
Mhm.
lives longer?
Woman.
Women live longer, which means if a woman has an annuity, they're going to receive less money. The men are going to receive more money. Less for the woman and more for the men.
Isn't this what they sell in cash value?
Say again?
They sell this in cash value with the annuities.
They do, yeah.
Do you need a securities license to sell that or no?
For if it's fixed, no. But if it has the word variable in that contract, then yes. Because remember, variable goes up and down. So for that one, you do require a security license. Okay. And the whole reason why they offer to clients is this. This is the greatest fear for clients. Is outliving their income, meaning that they get to retirement and then there's no more money. It's all gone. They got nothing else to come out for income, which means they're going to go back to work. All right, here it is. So the main purpose of a variable annuity and why was it created, it was to pretty much keep pace with inflation. Because inflation every year goes up about 2-3%. This year it went up to about 9%. So everything means here is that the cost of living is going to be getting up and up more each year. Okay. Because the investor takes on this risk, the product is considered a security. Individuals who are both insurance license, security license are eligible to sell variable insurance products. So myself, I can sell variable annuities. I can sell fixed annuities. Do I sell them often? Not really, because they're freaking complicated. Okay. There it is. And these contracts also include a death benefit. Beneficiaries will receive the greater of the contribution amount or the current value if the owner dies during the accumulation period. So what is accumulation period? What is that?
It's how much money they've saved up in the portfolio.
Exactly. Like it could be like they're maybe right now they're 50 and the time they're gonna take out the money is not until like 65.
It's the unrealized gains.
Exactly. All right, here it is. Premium payments for variable annuities are invested in what is called the separate account. Okay, so it's gonna have two different accounts. One of them, it's kind of like a mutual fund. We just can't call that, okay? And then right here, it's gonna be kind of like the life insurance part. Okay. These accounts would have various objectives to choose from, such as growth, income, as regular investments. If the investment manager of an insurance company is responsible for selecting the securities to be held in the separate account is directly managed and must be registered by the Investment Company Act of 1940 as an open and managed investment company. Pretty straightforward. Bum, bum, bum. Here it is. The performance of the separate account may be invested in one or more sub-accounts that are managed separately.
Donde esa es la mejor parte, no me distraigan.
All right. All fees directly related to the product must be
Está ya,
disclosed to a variable
Make
annuity.
sure you mute yourself.
All right. These products specify charges including administrative fees. And remember, annuities, they're gonna have surrender charges. Okay. Keep that in mind. Okay. And then right here talks about annualization. Can never pronounce it. All right, so an investor who reaches retirement may choose to annuitize their contract. So annuitize means pretty much that's the day they decide I don't want to work no more and I want to start receiving the money from my annuity each month. Okay, this is a one-time and irreversible election to give up ownership of the assets of the annuity in return for a lifetime income guarantee by the insurance company. Okay, so this part right here, what does that mean? What does that mean?
That it's no longer gonna keep building money. They're gonna start receiving money for the rest of their life till they die.
Exactly, that's all that means there. Okay, the amount of income is determined by the insurance company based on the annuitant's gender, age, account value, payout option, and an assumed interest rate, GAAP. Okay. And they could adjust for the rate of inflation. It is not part of this initial calculation. Here it is. Fixed annuity differs from a variable annuity. And one other thing here is that a fixed annuity will not keep up with inflation. And if you have fixed annuities, it might be like $3,000 a month. So it won't keep afloat with inflation. And they're just gonna give you a stated rate of return. And these are not considered securities. All right, cool. Let's answer these questions here. All right, so right here we have number one. So when a customer chooses to annuitize a variable annuity, all the following, so right here they pretty much said, I want to retire. Cash. All the following are factors the insurance company will use in calculating the initial payout amount, except
The gender of the annuity?
no, that's used. Remember, they're gonna give money, they're gonna give less money to men.
Yeah. Not historical
Me?
inflation.
Wouldn't it be historic inflation?
It should be D.
Mm.
Should be D. And then two, it was I'll probably get between either C or D. So I know for a fact they use age, they use gender. All right, two, the investment return of a variable annuity comes from okay. What do you think it is?
The investment return of a variable. So variable, it goes up or down, right? It's not fixed. So would it be C? The longer they have it because of the premium? No, wait.
That was A, the performance of the selected sub-accounts.
So A sounds right, but it does not separate accounts. So it should be A, right? Premium shouldn't really matter. I would say A. All right, so three, the decision to analyze a variable or fixed annuity may be reversed within how many days? So this right here, it sounds like a trick question, right? Isn't it A, 30 days? I would say it's 0 days because earlier we read that once you annotate a contract, there's no going back. So I would say 0 days. What do you guys think?
Yeah.
Okay, let's clear this out. All right, so 1 is D, 2 is A, and then 3 is C, 0 days. Okay, here it is. Is a one-time irrevocable action. And what does the word irrevocable mean?
That you can't go back, essentially. You can't undo
Yep.
it.
Exactly. All right, this part here, it's easy. So anytime when you have mutual funds, you're gonna have three different types of classes of shares. You can have A, B, C, and then no low funds, and you can also have a wrap fee. Okay, that's the different topic later on. It's more for like investment advisors when you have your Series 65. Okay, let's keep going here.
So you said there's three types?
Well, there's technically four.
Oh, okay.
A, B, C, and then no low fund, and then there's wrap fees. So
Okay.
that's the fifth one technically. All right, cool. Just read this paragraph here while I drink water. I talk about the pricing, how you buy shares. All right, let me know when you guys are done reading it. Are you guys finished? All right, perfect. Let's keep going. So right here it says, so they're priced at $12.34 per share. An investor wishes to invest 4,000. So all you do is very simple. You get the 4,000 and you divide it by 12.34 per share. And then right here is going to give you 324 shares. Okay, in other words, the investor doesn't need to specify purchasing any specific number of shares. Instead, the investor can simply decide on how much he wants to invest. Remember, with mutual funds, can you buy the whole share or can you do partial?
You can do partial. You can do
There you
both.
go. You can do partial. That's why we can get these amount of shares here, because we can do partial. Okay. An investor company portfolio is elastic. Money is constantly being invested or paid out when shares are purchased or redeemed. Okay, and then the value fluctuates as money is invested or redeemed, and plus the value of the portfolio can either rise or fall based on the market. Okay, let me go down here. All right, so an investor, let's keep going here. These are the characteristics. Let's keep going. All right. A professional investment advisor manages a portfolio for investors. Okay, so they're going to have a designated investment advisor looking over that fund. Okay. And they provide diversification by investing in different companies or securities. Okay, most funds allow a minimum investment of $500 with as little as $25 a month. An investment company may allow investments at reduced sales charge based on the amount of the investment. Okay, so that pretty much means here is that the more money that you invest, you're going to get charged a less sales charge from, like, let's say 5.75 to 5.5, etc. Okay. An investor retains voting rights similar to those extended to common stockholders, such as the right to vote, change of board of directors, etc. Okay, mutual funds must offer reinvestment of dividends and capital gains. Okay, without a sales charge. Okay, these remain taxable. An investor may liquidate a portion of these holdings without distributing the portfolio's balance or diversification. All right, so they're going to get 1099 forms. A fund may offer various withdrawal plans that allow different payment methods at redemption. Funds may offer reinstatement provisions that allow investors who withdraw funds to reinvest up to the amount withdrawn within 30 days. Okay, let's keep going. Clears out. All right. All right, perfect. This right here is very, very important to know. The maximum sales charge allowed is 8.5% of the public offering price. This right here is very important. You never know, they might ask you that question on the exam. All right. Let's keep going. All right, so right here we have Class A. Okay, so with Class A, they're going to get charged a load / fee in the front. Okay, so it's very simple. Let's say you invest $100. Okay, and let's say the sales charge is 5%. So that means that 5% of $100 is getting $5. That fee goes towards the mutual fund. So what you actually buy is $95. This right here is what goes into your investment, $95 after the sales charge. Here it is. The sales charge are paid at the time an investor buys shares, and the sales charge is taken from the total amount invested. Okay, so this right here is the way that we get paid each month passively. Now here's an example. So if one offers a 5% sales charge, an investor wants to invest 10 grand, because 5%, we're going to look at what the fee of that is. So that's $5. So what they're actually investing is going to be $9,500 towards their investment. Okay, all good here? All right, Class
Yes.
B shares, very simple. It's called a contingent deferred sales charge. It is paid at the time the investor sells shares previously purchased. Okay, and the sales load is a decline percentage charge reduced annually. So the first year we sell it, you're gonna get charged 8%. Second year, 7%. So throughout the years, it's gonna get reduced and reduced. And eventually, after a certain time period, it's gonna convert from Class A, including Class B, to Class A. And no sales charge will be applied at the time of redemption. Okay. Let's keep going. And then just read this note right here. Read this note here. This note. Right there, it tells you the disadvantage of doing so between Class A and Class B. All right, so what does the first paragraph mean? What does it mean? This part here, what does it mean?
It means that your whole investment is invested in the shares. They don't take 5% off.
Exactly, they won't take the 5% off. So you're gonna buy a whole bunch of shares without the sales charge up front. Okay, now here it says that it might seem appealing to do so, but let's say that that 10 grand that you invested, it went up to 15 grand. And let's say you want to take out money in the second year, let's say your sales charge is 6%, you're gonna be paying a more higher sales charge at 15 grand versus 10 grand if you would have paid that sales charge in the beginning. Okay, does that make sense?
Yes.
So obviously, if you plan to take out like a lesson in short time, then this right here is not your best option. Right here. Aren't held long enough to have the sales charge just be zero. The sales charge can be costly at redemption. All right, and then Class C shares.
So you basically want to hold it longer. So
Yep,
you
the longer you have it, less sales charge.
got it.
All right, and then
Every year, right?
every year
drops?
it drops down.
Okay.
Okay, and then Class C have a 1 year CDS, I forgot what that means. And then right here it has the fees. So 12B1 fee, it's it's used to promote the fund discussed later, like advertising. So when you get your Series 26, this right here is an additional paycheck. Okay, additional paycheck each year. It's only given to you at the end of the year. So I can't wait to the year. I'm gonna get like a little bonus. All right, now there it is. Because these fees never go away, C shares are commonly referred to as having a level load. Class C shares are appropriate for investors who have short time horizon because the annual charges make them expensive to own if investors have it for more than 4 or 5 years. So this here, it's mainly for short-term investors. Short-term. Okay, and then right here we have no load funds. So no load funds has a word right there. They're not going to have any sales charge, technically. They can still have some fees involved, like transaction fees and whatnot. Here it is. Let's skip here. Here it is. Not every type of fee passed on to shareholders is considered to be a sales charge. They're permitted to charge fees that are not considered sales charge, such as purchase fees, account fees, exchange fees, redemption fees. Okay. Okay, perfect. All right, this little chart here, make sure you guys memorize it.
Wait, question. So basically, if it doesn't say sales fee, then that's why it's considered a no, what's it called? A no sales?
Yep, that's pretty much why.
Okay.
All right, and this right here is pretty much all you gotta know when it comes to what is best for your client. A, B, and C. A shares are designed for people with large investments, they have breakpoint sales, and they have a long time horizon to actually invest. B shares are best for investors with smaller investments and longer time frame to get past the contingent loads. And then Class C shares are best for investors with short time frames. Okay. Let's keep going. All right, here we go. All right, so number one, which of the following is not a true of no load shares? They have fees associated with sales and redemption. Is this correct here? Sales?
Correct.
Okay. They are redeemed with no charge or fees of any kind.
That's true.
They are sold by the fund with no sales charge or fees of any kind. They offer more return per dollar invested versus load funds. So what you guys think it is?
A.
A? You guys agree? You guys all agree it's A? What do you think it is, Angel? Let's put A. All right, cool.
Never mind. Yeah, I saw the not true part.
All right, Class B mutual fund shares are also called
C.
You sure it's that?
Angel.
C.
B.
I say B.
You think it's C? I would say it's gonna be back end load. Remember, this one here, the way it works is that there's no sales charge in the beginning, right? So in anything oh, there's no sales charge in the beginning, more than likely it's going to be deferred. I think back end was class C, if I remember correctly. You guys think it's still C or is it A or B? Or then D doesn't exist. Does not exist.
B.
B. All right, and then 3, Class A shares are best for investors with large investment amounts. And nope, that's wrong, right? Smaller investments, long time. This part here is right, but this part here is wrong. Okay, and then right here, C looks like it's right. Long time horizon, large investments, smaller investment amounts in short time frames. That's wrong. So it should be C. All right, cool. And let's close out. So 1 is A, 2 is B. So read the little description. Guys got it?
Yes.
All right. And then C makes sense. All right, so breakpoints are very, very simple. So breakpoints are quantity discounts and open and management company offers. The greater dollar amount you're going to buy, the greater your discount, the sales charge. Okay. Now the way it works is very simple. Let's say you have $1,000 you want to invest. You're going to get charged at 8.5 sales charge. But let's say you have 10 grand. You want to invest 10 grand, it's going to go from 8.5% to 6.5%. Okay. So the more you invest, the more that sales charge is going to be going down. Okay. Here it is. Using a simple breakpoint table, assume a customer had 23 grand to invest. At that level of investment, so look here, 23 grand. So at 23 grand, they're literally about 2 grand away from 6.5 to 4% sales charge. So now as a person that is investment specialist, you gotta inform, hey, Mr. and Mrs. Client, right now you're at $23,000. You're at $23,000. The next breakpoint is going to be at $25,000. Do you have that extra 2 grand to invest? It's going to break your breakpoint sell from 8.5% to 4%. And most clients are like, you know what? I can do that 2 grand today. No problem. Perfect. So they get that sales break sell from 6.5 to 4%. Okay, so it helps the client in the long run. So as when you do investments, you always have to inform the client of that breakpoint sell. If you don't, we can get in trouble for that. Okay, so you always got to inform the client that they have an opportunity there to get to that breakpoint sell. Okay, so that's that. And it's an easy way to help your client actually invest more money. I had a client that had about 35,000 under about 35 grand with me, right? So I told her, hey, you're about 15 grand away from the next breakpoint sell. It'll get you down from 5.25 to 4.5%. Did you want to invest additional 15 grand? And she said, yeah. So that point, I pretty much did that 15 grand investment and they got this breakpoint sell here at 4.5%. So it's always good to help your client out in the long run. Maybe you get paid less for it, but who cares? Okay, and then right here talks about letters of intent. So letter intent is very simple. Is that it's going to be a letter where you say that within 13 months, you're going to have that money to get you to that next breakpoint cell. Okay, so you have 13 months to get to that breakpoint cell. If you don't get there by that time period, then let's say if you were charged at a 4.5%, you're going to go back to the 5%, wherever it was before that sales break. Okay. And they're going to adjust the sheets and whatnot to charge you more fees, pretty much. All right. There's a one-side contract bind on the fund only. The customer must meet the investment quantity to reduce the sales charge. The fund holds the extra shares purchased from the reduced sales charge and escrow. The customer who deposits the money to complete the letter of intent receives the escrow shares. Appreciation and invested dividends do not count towards the letter of intent. Okay. So this right here means that appreciation and investment dividends do not count towards letter of intent. What does that mean? What does that mean here? So what's the only thing?
So if the account grew, or if it received dividends, it doesn't count. Like if the board of directors said everybody's getting like a 5% dividend increase, that wouldn't count for it.
Yep, that wouldn't count. Okay, so now what this here means is going to be this. So whatever amount that you purchase, that is what's going to count towards your letter of intent. So if you bought $20,000 of shares, this right here is what counts, what you actually purchased. Okay. So now let's clear this out.
So then you would need to invest more, right?
Yep, you have to invest more.
Got it.
Boom, boom, boom. And then rights accumulation means is that throughout the years, you're going to be investing more and more. And then when you can actually get to those next breakpoint cells. Okay, very simple. And then rights of accumulation, it's only valid within the same fund families. So a fund family can be Fidelity, Franklin. Okay, so Franklin, Fidelity, they're fund families. Fidelity and Franklin. So if you have everything with Franklin, you're going to get that rights accumulation faster. But let's say you have 25 grand with Fidelity and then 25 grand with Franklin. Will you get rights accumulation between these funds to get you $50,000 for a breakpoint cell?
No,
And why is that?
because they're two separate funds.
Exactly, two separate funds. That's why when you sit down with a client, it's very helpful to find exactly what they have before they actually open up their investment account with us. So let's say that they have a fund with Fidelity, and we offer Fidelity, then more than likely we're going to offer them Fidelity, assuming they have mutual funds that are Class A with us. Okay, we can easily transfer it over, best interest for our client, etc. But if let's say they have a fund that we don't offer for Class A shares like Vanguard, index funds, that kind of stuff, then you can put them whatever you want because we don't offer it. Okay, so that's that. And then here says combination privilege. There it is. Family of funds and investors seeking a reduced sales charge may be allowed to combine separate investments in two or more funds within the same fund family to reach a breakpoint. Simple. Okay. And here it is, exchange privilege. Many sponsors offer exchange or conversion privileges within their family of funds. Exchange privilege allows an investor to convert an investment in one fund family for an equal investment in another fund in the same family, often without incurring an additional sales charge. So all this means here in lame terms is that if I have 10,000 shares from Franklin, let's say it's aggressive. Okay, aggressive fund, whatever it is. I can trade this 10 grand, exchange it for different funds in Franklin. And they won't charge me no sales charge. Okay. No sales charge if you keep within the same fund family. But if let's say the client wants to exchange it from Franklin to now Fidelity, they're going to accrue another sales charge. Okay, when that happens, that's going to bring another red flag for us here. Okay.
Question.
Yep, go for it.
So when you do like a 1035 exchange, is there a sales charge to transfer them funds?
Yes, there is.
So you can't get away from that, huh?
Nope.
Got it. Thanks.
Yeah, 1035s are a little bit difficult.
And are the sales charge going to the broker? So what I mean by that, like, would it go to like Robinhood, TD Ameritrade, Fidelity? So whoever like the platform is that who the sales charge is going to?
Exactly. It's gonna go to that fund, that company, and then for us, I'll give you an example. So for us, we're gonna get paid off that sales charge, and a small portion of that will go to the
Agent's compensation?
Fidelity, whatever it is, because we gotta get paid. Here it is. Breakpoint sales. On the other hand, it is a term used in the security industry that means sales below the breakpoint. Allowing a sale to incur an amount just below a breakpoint can be viewed as an effort by representatives to share in the higher sales charges. Okay. Let's keep going. How many more pages do we have? Let's see. Almost done. Got in. I forgot how long the section is. We're gonna speed a little bit. We're gonna skip this section, that quiz right there. All right. So as far as pricing, it's gonna be different between closed end and open end for mutual funds. Meaning for investments. All right. So here it is, and these equations you're gonna have to memorize it. I'm not gonna go over it because this is something you have to go over on your own to actually memorize these equations. All right, keep going. And here it talks about expense ratios. Here it is. Compares the management fees and operating expenses, including any 12B1 fees with the fund's net assets. All mutual funds, both loan and no loan, have expense ratios. And each fund is going to be different. Now, I'll give you right now an example. Fidelity is more than likely going to have more fees for expense ratio compared to, let's say, Franklin, those different companies. Okay.
Why is that? Because they're more recognized, or they're
Yep, the more recognized you're paying for the brand name.
okay, just like anything, right?
Mm-hmm.
All
And
right.
they're pretty good too.
Yeah.
And here it is. Look. So anything between 1% and 1.5, they're more aggressive funds, which means they involve more management. They're actively overseeing that fund. Okay, so if you look right here at tools.finra, I'm gonna show you two different funds, FKGRX and then EPVAX. Analyze. So right here, let's skip down. It's gonna be, there it is. So right here, these two funds, they do exactly the same thing. They both do large growth. Okay, and then they both do short. And then right here for the annual expense ratio, it's a 0.97%. And then Franklin, it's a 0.79%, and they both do the same stuff. Our returns are about the same.
Sheesh, this year has been horrible. -20, -23.
Yep. Burwell is a down market right now. Burwell. All right, so that's that. Let's keep going. If not, we're gonna be all night. All right, this talks about disclosures and taxation, the full and statutory prospectus, summary prospectus. So this right here, you have to know exactly what is on every type of prospectus, statutory prospectus, summary prospectus. Now for sell, you can use the full prospectus or the summary prospectus. Okay. And whatever you're using to sell that product, you have to provide them that document. Okay. Now, if the customer asks for a statement of additional information, which is very rare, I haven't had a client that asked for it yet, it's going to have a bit more details, and you have to deliver to them within 3 business days. So is Saturday and Sunday considered a business day?
No, sir.
No.
Nope.
Nope.
All right. Perfect. Let's keep going here. So right here's your little hot sheet. What to expect. So this right here, I would say memorize it. This little table. All right, let's keep going. And here it is. So there is a way the fund can actually reduce their taxes. And that's if they distribute at least 90% of its net investment income to the shareholders. If they only get back 89%, they're going to get taxed on 100% of the net investment income. So they're always going to do that 90% or above to avoid paying that taxation. Okay, let's keep going. All right, let's do a quick quiz. That was it. Let's get here to securities licensing. You guys learning?
Yep.
Yes.
Yes.
Let's go here.
So how does it look like from an RVP standpoint when you're doing an investment? So where do you go? Like, it's not like Turbo Apps, is it?
Same thing.
You go to Turbo Apps?
Yeah. It looks like this. Prime America app. And then right here, Turbo Apps, Life app, Easy Key.
Mm.
So I don't think you have Easy Key visible on your end. It's not there until you have your Series 663. Yep, but everything else here. And the commission's better too.
I bet. Now you just need to build it.
Mm-hmm. The longer Ceci and them take to get their investment license, the better for me. All right.
Can't promote nobody without a securities license though.
Mm-hmm. Oh, I forgot about that. They can't do it, huh?
I don't know about them. I'm just saying in general.
Right now we're doing today unit 4. Let's do. They're all good. Do 20 question. I think we have enough time. Mom's already falling asleep there against the wall. All right, cool. Wait, no, I think is this unit 4? Oh well, I think it is part of unit 4. All right, here we go. So here it is. Which of the following are associated with manipulative, deceptive, or fraudulent devices? So is breakpoint cell one of those?
Yes.
Yep, it is. Good to counsel, that's not one of them. You're gonna learn that term later on in the book. It's like whenever you have a trade for options, whatever, that it's good literally until it's canceled. That's it. And then fill to kill, it's good. And then churning is pretty much commission. You're selling for commissions, which is bad. So it should be between 1 and 4. So it should be 8. You guys agree?
Yes.
Yeah, it is unit 4. Moving in the book. All right, cool. Now we have here this question here. Why is a fixed annuity not considered a security?
B.
B, because there's no real risk because it's fixed.
Yep, that should be it. All right, which class shares have a 12B1 fee as the primary sales charge?
C. I mean D.
D? Or is it not B?
No, because they don't have a fee.
There you go. Read through the description. All right, a variable annuity investment return each month is based on
The performance of the separate account.
D.
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 Yeah.
At a shareholders meeting, a mutual fund investor might be called upon to vote on any of the following except all right, let's look at it. Changes in membership in the board of directors, whether to sell a certain company
C.
stock.
C.
Which one is it?
C.
C?
hmm
There it is, 2 and 4.
Changing the new landscape for the fund, like, bro, come on.
I didn't even read it. All the following are true regarding breakpoints for mutual funds except
A breakpoint sale is considered to be a sale just below.
that's true, right?
Yeah.
B, the greater the investment, the lower the sales charge. That is true.
No, D. As in dog.
The first breakpoint can choose mandated by industry. No, it's different. It can be different. D. All right, 7, regarding open-end and closed-end investment companies, all the following are true except
B.
B.
I would say C.
Okay, right here saying are true, right? So we're looking for a false statement.
I would still say C.
Oh yeah, we see. Remember, closed end doesn't have alpha and limited. There it is. Let me just post this thing on Instagram. Oh, you're posting, Angel?
Yeah.
So for the people.
All right, cool. Now go to the next question here. All right, what limit is placed on the number of outstanding shares a mutual fund may have in the hands of investors?
What is the placed on the numbers of outstanding? There is no limit.
C.
C. There is no limit.
There it is. All right,
Mutual
mutual funds that market directly to the public using no underwriting and charge no sales charge or call.
no load funds. C.
There it is. Which of the following would cause a mutual fund net asset value per share to fall?
Market value of the portfolio declines, so the third one is true.
So you think it's so okay, so now you think it's 3, so we're gonna look for 3s. So between D and A.
If they pay a dividend,
D.
they're not losing money, are they? No,
I would say
because that's
D.
paying a dividend is extra money of profit they made. They're giving back to their investors.
Yep.
So they're not losing money, they're actually gaining money because more people are willing to invest in that company.
Mm-hmm.
So that's not really gonna make the net asset value drop. It would actually increase it, wouldn't it? So it can't be D.
All right, cool. So sound like maybe A, right?
Yeah.
It's D.
What? How? Explain that to me.
It was
Read,
the other way around, Nejum. You were on the right track, but it was just the other way around.
Wait, I'm confused.
read the description.
Paying a dividend and suffering market declines both reduce the net. Oh, it does make it fall by paying dividends?
Yeah. You were on the right track, but it was the other way around.
But if I'm paying a dividend, isn't wanting more investors coming along? So shouldn't it make the net asset value go up?
No, it's actually think about it like this. Let's say I own your company shares,
Mhm.
and you have to pay me a dividend. Are you gaining money or are you losing money?
I'm losing money. I am losing
There you
money.
go.
Okay, it's D. All right, cool. Thanks. Bro.
All right, keep on going.
Advantages to the investor offered by the investment companies include advantages to the investor offered by investment companies. Advantages to the investor offered by the investment companies. It's the fourth one.
So number 4.
Yeah, wait, let's look. And then it's 1 or 2. Advantages to the investor offered by the investment companies include ability to invest small amounts in many different securities. That is true. Special security prices available to only invest in a company. It's 1
I
and
would say
1
B.
and 4. 1 and 4.
There you go. Read the little description.
Yeah, 1 and 4. Cool. Good job, Angel.
All right, perfect. All right, a mutual fund share class determines.
Determines. And mutual fund share class determines.
C, how sales charge and related expenses are paid.
There you go. Class B mutual fund shares are also known as.
Back end B.
There you go. These are easy questions they give you on the exam.
Class C is also known as intermediate.
I think it's B level though, no?
We're about to see.
Yeah, isn't it B level up?
So I don't think intermediate shares actually exist. Remember, they're gonna throw out words out there that don't actually exist in the market.
Which of the following would you expect to have the lowest expense ratio? Small cap growth.
You sure?
Yeah.
On?
Oh, see, I'm reading it too fast. It is a bond.
All right, under which of the following conditions will an investor be able to purchase mutual fund shares and pay no sales charge? So we're looking for pretty much like Class B shares.
I would say A.
It's not B, I'll tell you that. If the customer has
A.
standing upon. The rest of them don't make sense. Yeah, I'd say.
All right, an investor asks for a copy of mutual fund statements.
3 business days.
A.
An investor has entered into a contract to pay an investment company a specific sum of money in exchange for the company's agreement to pay the investor a specific large sum of money on a specific day in the future.
D.
Sounds like D, right? There it is. All right, a mutual fund public offering price is $15.23. An investor wishes to invest.
C.
Man, the math pretty quick.
That's not that there's no math. He didn't do no math. It just makes
No, there's no math. It's just easy.
yeah, there's no math in it.
You know why he said that? Because price is 65 shares. Because there's no way in hell you're going to get a whole number off this number here.
But how do you figure that out? Just like that?
You get the 1,000 and you divide by 15.3. And it'll give you 65.66 shares.
Yeah, but it also makes sense. Like they're not gonna give you anything else. You're buying shares. If
Yep,
there's
and
supply and a demand, they're not gonna give you anything else extra.
Yep, and they're not going to give you change back.
Okay,
And
thank
this
you.
figures it rather than 2. Must purchase some multiple of 100 shares. Oh shoot. 20.
The violation of selling mutual funds just below the point where the customer would qualify of lower sales charge, not informing the customer that they may qualify for a lower capping.
Capping.
Is it capping?
It's
No,
gonna be
it's
A.
the breakpoint sales.
You capping.
Nope. The key thing here is sales charge.
Well, it's not a breaking point sale. So
It
is it?
Yeah.
There it is, 95.
Hey, we didn't do bad. 95%.
We're good.
All right, perfect. Well, that's it for tonight. Be sure you guys keep up with the syllabus. I think this weekend you guys are reading Unit 5.
What's our
6.
next class?
Yeah, for next class.
When's our next class?
It should be Monday.
So is it
19th.
Monday, Wednesday, Fridays, or just Monday, Wednesdays?
It's gonna be Monday, Tuesday, Wednesday, Thursday.
Oh shoot! All right, bet.
I don't think for a while we're doing Wednesday classes, right?
I'll have no more Wednesday training.
Right? We don't have it for a while, so we're good there.
Okay.
So how much do we read?
A lot more.
No, till Monday.
So it's gonna be Unit 5, 6, and 7. So it's on that Dropbox link that I sent you guys. There's a syllabus. It shows you what to expect every day, pretty much. Just like college. All right, perfect. Any questions, you guys?
No, thank you, Oscar.
Thank
No
you.
problem.
Thank you.
No problem. All right.